Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, September 3rd, 2024. Welcoming everyone back from the Labor Day holiday here in the States. Hope everyone had a fantastic summer. We're excited to kick it off this fall. So as always, we'll start with the executive summary from our leadoff morning note today. As always, if you would like to see the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will investors gain confidence to broaden out into cyclicals this week? And will the Bank of Japan catalyze another positioning unwind? Our answers are, the first week of the month always contains several key economic releases, most notably global manufacturing and services PMIs, the ISM manufacturing and services PMIs, and the US jobs report. Now, the Fed Beige Book on Wednesday will be telling as well. We reiterate our call for U.S. growth to continue generally surprising to the upside throughout the second half of 2024, as most recently evidenced by last week's GDP and PCE data. Bank of Japan Governor Kazuo Ueda reiterated his previous guidance that the BOJ will continue to normalize Japanese monetary policy if growth and inflation perform as expected. That is likely to be the case over the medium term, according to our Japan grid model. As such, investors should prepare for more tightening and more yen carry trade unwinding in the months ahead. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding inflation in 2025. It says, hi, Darius. Thanks for everything you do. I have a question on the inflation projections that you have for 2025. I'm trying to understand how bad inflation will come back in 2025. If the inflation is really going to bottom in the second half of 2024, and since the inflation has been coming down every month throughout the whole of 2024, does that make the year-over-year base effects of 2025 even worse? Based on your projections, it seems like it might go towards 4% by June next year, but it will still be much lesser than the 8 to 9% that we had in 2022. Does that mean inflation will still be tame? Is that a correct assessment? I wouldn't necessarily say tame would be a correct assessment if we started to see inflation reaccelerate as our model currently projects in the first half of next year. If that outcome is materialized, it will represent a material divergence from consensus expectations, which are calling for inflation to continue slowing throughout the year. And that is also consistent with what the Fed is projecting in terms of the path of inflation continuing to slow. The reality is that there has been no evidence in the history of the post-war U.S. economy of inflation returning durably to trend in the absence of a recession after we've had a inflation spike. In fact, then when you go back and you look at the 12 business cycles that we've had in the post-war U.S. economy, there has been no evidence of inflation breaking down below trend until 12 to 15 months on a median basis after a recession. In fact, you look at the path that inflation historically takes into recession, it typically decelerates, then reaccelerates right at the beginning of the recession, which I would argue is probably one of the drivers of catalyzing the recession, because you get the margin squeeze that causes businesses to start to fire people. And once people start getting fired, they start to pull back on consumer spending. And this is obviously a 70% consumer consumption economy. So, just kind of getting back to the question, will that be tame? Most likely not. I wouldn't put too much stock on the actual numbers. There's always forecast error on the actual numbers, especially the further you go out in time. But the reality is the rate of change should become unsupportive relative to those consensus and Fed expectations. And this is why we see a tremendous amount of risk in the bond market starting next year, because again, we don't see a recession as a material likelihood over medium-term time horizon. And if the U.S. economy continues to expand and we continue to put, upward pressure on inflation through the lens of, continuing growth in the labor market and continuing taxing of available labor resources, if that becomes the case, then you're very likely to see inflation, kind of start to meander higher again next year. And again, with this in the context of everything that's priced into the forward rate curve here in the U.S., that could cause some problems and consternation in the bond market. But again, we're having a conversation about 2025, and it's September of 2024, and there's a lot more market risk that I think you have to deal with from a growth and inflation standpoint that's different than what we're talking about now. And so I think, this is not something that markets are going to have to price in over any time soon. In our opinion, this discussion about inflation and where bond yields might be headed throughout 2025 is probably going to be something that we have to deal with as investors in the first half of 2025, not in the second half of 2024. So just be aware of that. It's an important conversation to have, but it's not necessarily something that you need to put on in your portfolio today. So we'll wrap it up there. Darius presenting our macro minute for Tuesday, September 3rd, 2024. Best of luck out there today. Everyone have a wonderful day. Catch you back here tomorrow. Cheers.